Okay, good morning, everyone, and welcome to our this month market webinar. I think it's the third or fourth time that we are hosting this webinar for our clients and investors. As always, I'm just going to give you a very brief summary on the recent market developments and how we see the different asset classes for the next couple of weeks, months, and years. So I think currently we're obviously in a very interesting times in terms of markets. So a lot of things have happened in the last month. So I think we're very happy to share our latest insights with you guys. So I'm going to quickly start with our company for those that joined the first time this month. So for those that don't know, Katch Investment Group, we are a small boutique asset management company, and we are entirely focusing on private debt. We have different investment vehicles that invest in private debt, and our niche is really that we sort of focus on the short term, on the liquid space, where we can offer monthly liquidity to investors, and we tend to have objective at around 8 to 10% return in our different investment vehicles. We also offer services for external asset managers and private investors, where we talk about markets and give model portfolios and so on. And in this business line, we basically give you the views on the markets and how we would position right now our portfolios or different client portfolios with different profiles in the current market environment. So on the economy, I mean, we've been talking about it over the last couple of months. We have seen recently some further indication that we are really seeing a manufacturing recession in a big parts of the world. So if you look at the chart of different manufacturing PMIs, you can see that right now most of them are in contraction territory. So below 50 means contraction in the PMI language. Until recently, the US was still relatively positive, but now also the US is in negative territory. So the bigger economies like the Eurozone, Japan, the US are now all in negative territory, which really shows that the economy, the global economy, is suffering from the trade war that is going on primarily between the United States and China. Another big news over the last couple of days has been Brexit, the whole Brexit story. I mean, it's also like a bit of a never-ending story, because if we remember, the Brexit vote happened in 2016. Now it's more than 3 years ago, and we are still talking about Brexit. Sometimes it happens to me that I ignore the news because one gets a bit tired of always listening to the same stories. But right now it's very interesting because we have had a lot of news since Boris Johnson basically took over control of the administration. So what we have seen is basically that Boris Johnson has lost a lot of support recently. So first, the pound was very weak because of hard Brexit fears, you know, earlier this year. But recently we have seen a rebound because basically Boris Johnson has lost very important votes in the parliament. So his solution for a Brexit agreement was declined. His proposal of having the possibility to have a hard Brexit if no deal can be achieved by the deadline of October 31st was also declined by Parliament. And finally, he suggested, or he wanted to push for a new election, a general election in the Parliament, and this was also declined by MPs in the UK. So basically, he hasn't had a lot of success, which also means that the turmoil is going to continue. We don't really know what's going to happen, but at least in the short term, let's say until October, it's highly unlikely that we see a hard Brexit, because we don't have a legal background to go ahead with a hard Brexit in the UK. So what is most likely to happen right now in the UK is that, first of all, right now the parliament is suspended by October 14. So there's not a lot of things that is going to happen in terms of votes in the parliament, that this is done. So Boris Johnson is probably continue to working on to find a solution, as we have seen it in the last couple of days with the visit to Ireland, so on. The Irish backstop, which remains one of the key discussion points, but it's, let's say, a deal is possible, but the likelihood is very small, because the views of the European Union, Ireland, and then the proposal that he has been talking about, Boris Johnson, recently, are still pretty far away. So what it basically means that as we are running out of time and he has no way to do a hard Brexit right now, the most likely scenario is he needs to do what he at the beginning didn't want to do, which was to seek an extension of the deadline, probably until January 2020. And by then, many things can happen, including a general election, maybe in November, where he might try to seek more support in the parliament. But because what we have been seeing recently is really a split also of the Tory party, with some of the party members being expelled from the party. So right now, the most likely scenario, it's probably an 80% probability, is that we're going to see an extension, a new election somewhere before the end of the year, and then a new way to try to find a new agreement by January with the European Union. We would say that the pound is now very well supported because of the reduced risk of having a hard Brexit. I would say hard Brexit risk might be 10 to 20% max. And if this happens, the pound could fall to 115 or even below. If we don't have a hard Brexit, it's more likely that we see a recovery towards 130 over the next couple of months. So on the margin, after some bad news over the last couple of weeks, the news has been rather positive, because the risk of a hard Brexit could be reduced a little bit. When we look at the US economy, we have read a lot about recession risk recently. So it's very important to keep following the economic data that is coming out. So last week we had some very important economic data that I mentioned it briefly at the beginning. We had the US manufacturing index and the non-manufacturing index. And it basically confirms a bit the picture that we had of the US economy over the last couple of months. On the one side, let's say the weakness in the manufacturing part of the economy continues, which is like a general trend in the whole economy, as shown in the chart at the beginning. But now the manufacturing index also fell below 50, as I said, which is a bit worse than expected, because forecasts for August were at 51.1. Now it came in at 49.1, so it was slightly disappointing. But at the same time, we had good news from the non-manufacturing part, which came out stronger, actually showing a rebound to 56.4 versus only 54 expected. So we really see a strange US economy, where we see the manufacturing part sliding into a recession, one could say. And at the same time, services and also the consumer part of the economy is holding up pretty well, as we have also seen, let's say, in some other indicators like retail sales, result of retail companies, and so on. So given that the US is an economy that is really driven by consumption, which is like 70% of the economy, right now the recession risk isn't really that high, and probably the US economy is still achieving growth around 2% this year, and maybe a slowdown next year, but it's still some margin before it gets into a recession. It's really key to see how much more the manufacturing part of the industry can weaken without having an impact on, let's say, on the consumer. So what we have to really check is the health of the labor market and also of the stock market. So if we look at the labor market, we just had the results last week from August, where we saw that actually we had a little bit a weak figure in terms of non-farm payrolls, which came in at 130, which was weaker than expected. But at the same time, the unemployment rate remained relatively stable at 3.7%. And earnings, they were also holding up pretty well, with a year-over-year growth of 3.2%, which was a bit lower than in July, where we had a 3.3% increase in terms of earnings, but still it's a relatively healthy figure, which should support the consumer. And I think it's also pretty normal that given the low unemployment rate that we have right now of 3.7, that the job creation can slow a little bit without having, let's say, causing major concerns in the economy, because it's just normal that given the low unemployment rate, it's not possible that the economy continues to create that many jobs. And if we look at the average figure over the last 6 months, it's still relatively healthy at 150K. I think it would be more alarming if we see a couple of months with zero job creation or even job destruction. But so far, this hasn't happened. We have seen that in the last couple of months, every time we had a weak figure, the market bounced back in the coming months. So we will see. But right now, the consumer part of the US economy is still relatively solid. When we look at the let's say what's going on in the next couple of weeks, it's obviously very important to see the monetary policy decision that we're going to see this month. I think it's extremely important. We have the Fed meeting next week on Thursday. We're gonna know the decision. And right now we have a 91% probability of a 25 basis point cut in September. This probability has changed a little bit over the last 2 to 3 weeks. When we had a bit more stress in the market a couple of weeks ago, there were even some probabilities of having a 50 basis point cut. They have now gone completely away. So right now the futures are implying 91% probability of having a 25 basis point cut, and the rest of the probability, a 9% probability of having no cut at all. So we really see that, at least in the short term, given the market rebound, and also given that the yields have recovered a little bit over the last couple of days and weeks. The US 10-year Treasury yield is now at 165. The 2-year yield is 160. So the yield curve is not inverted anymore. This has also meant that the expected rate cuts have moderated somewhat, but still the market is still implying 3 additional rate cuts over the last 12 months. So which basically means that from here in a year, in 2020, mid-2020, the market is implying a Fed funds rate in the range of 1% to 1.25%, which still means a much looser monetary policy over the next month ago. It's to be seen whether the market tries to retest the Fed, and we might see some pressure on the Fed going into the meeting. This is always a risk to try to see whether it can get a bit more from the Fed. But right now, the stability of the market is relatively solid. One that can maybe change the expectation a little bit going into the meeting, because we are not going to have that many economic indicators over the next couple of days, because the meeting is already next week. So what we do have this week is CPI inflation news in the US on Thursday. So I think it's going to be very important to watch the figures. What the consensus is expecting right now is that headline inflation remains at 1.8% in August, which is the same level as in July, and that the core CPI trends up a little bit to 2.3% versus 2.2% in July. So if we have a surprise in terms of inflation, and inflation comes in weaker than expected, we might see that the market will try to test the Fed and to get a 50 basis point cut. So I think this could eventually be a catalyst if we get a surprise on both sides. Important is that the Federal Reserve actually looks at the PC, not at the CPI figure. The PC, we're not going to know a new figure in the PC anytime soon. So the next one is going to be published on September 27th, and is expected to be stable at 1.6%. Also, 1.6% really shows that for the Fed, given the recent market volatility and the slowdown in manufacturing and also the risk to global trade, it would be very hard for the Fed to justify to keep interest rates on hold, which probably means that the 25 basis point cut is more or less granted going into the week. This week we also have the ECB rates decision. I don't have a chart on that one, but I think it's also important because if we look at the development of the fixed income markets, let's say in the last couple of years, it's very important to look at Europe, where we have seen much more pressure on yields, and the pressure on yields in Europe also obviously have been a big driver for US yields, like anchoring the US yields or pushing US yields down as well, just because of the differential that we might have between, let's say, the German bond and the US Treasury. So we're going to have the ECB meeting this week. Given the very weak state of the European economy, basically very close to have a recession. Germany contracted slightly in the second quarter, so Europe the growth has been very fragile over the last couple of years, and right now we are very close to slid into negative territory again. So what the market is expecting and what the policymakers have somehow indicated is the possibility to have an additional rate cut in Europe. So the deposit rates in Europe right now are at minus 0.4% negative. And what is expected right now in the market is that the ECB is going to cut it to minus 0.6%, which is not without risk, because we know that negative interest rates can also make some harm to the financial stability, because banks are penalized on having reserves at the ECB. So one thing that the ECB is considering right now is tiering, which is it's known in Europe because it has been implemented in different ways in Denmark and in Switzerland, which basically means that a part of the reserves that the banks hold at the central bank might be excluded from the interest rate penalty right now. It's really a strange world right now where a lot of people have to pay interest rate in depositing money, and in some cases, as we mentioned in one of our articles recently, in some cases like in Denmark, where we have negative yields on mortgages, which is really crazy. So monetary policy might help a little bit to stabilize the markets and really to push down longer term yields, which are already negative. So, but the impact, the economic impact, is probably pretty small from here. What we might also see is a new quantitative easing program announced by the European Central Bank. But here as well, the supports, quantitative easing is not supported amongst all countries in the Eurozone, and especially the two biggest economies, which is Germany and France, are not really supporting quantitative easing. So if they announce something, it's probably not going to be much more aggressive than currently expected by the market. So on the margin, I don't believe that the ECB is really able to surprise the market positively and to push stocks up or bonds down. It's going to really be hard to see that. So if we look at back to the US, if we look at the recession risk, so there are different indicators like the one from the New York Fed that we are showing right here. So we can see that the likelihood of a recession in the US for the next 12 months is 40%, which is not low. So it's a significant risk right now. I mean, the most important indicator that they look at is the yield curve in the US, which has been inverted. The 10-year yield curve has been inverted over the last couple of weeks. Now it's back in positive territory, slightly positive territory, but still it's very tough to assess the state of the economy right now, because it's pretty normal that if the trade war continues and the manufacturing recession continues, at some point it's going to spill over to other parts of the economies. So the likelihood to have a trade war or not really depends on trade talks. Over the last days and weeks, we have seen some reliefs because China and the US, they announced that they're going to have new talks in in October. So that's also why the market rebounded a little bit. But I mean, if we learned something over the last couple of months, is that you should never feel too comfortable about this announcement, because it can change anytime. So I think the market has been relatively calm and relatively confident, despite the huge tariff announcements that we have seen towards the end of July, which is a bit surprising. And I think the main argument of the market, or the main reason why the market is really calm, is there is a common belief that because we have elections in 2020 in the US in November, that President Trump really will try to get a deal done at some point in order to avoid a recession, to win the re-election. But this is certainly far from granted. Also, given the let's say the different situation that the Chinese have in terms of negotiation, because the Chinese, they don't have elections, which is an advantage if you have to go into negotiations, and they have a much longer plan. So for them to have a hit to the economy in the short term in order to get rid of Trump is probably not a bad option. So we'll see. Certainly the negotiations are not going to be very smooth. So we expect that the market is continue to be pretty volatile over the next couple of weeks and months. So if we look at the S&P 500, as I said, we have had a very nice rebound starting in September. It has been driven by financials in the US that have had some analyst upgrades and some reliefs. We also saw that some underperformance year to date, like energy, given the recent hike, the recent rise in energy prices, they have rebounded a little bit, and some value stocks, they have rebounded a little bit. So I'm not sure whether this is really a new trend that we see in the market, because some of the growth leaders, they haven't really performed very well, and some of the weaker stocks, they have rebounded. So it's a bit an argument that speaks against a duration of the trend, of the rebound. But at least technically, the situation looks now a bit more positive, where we see that the S&P 500 broke out of a trend, a similar trend that we saw, let's say, in October, November 2018, where we had some ups and downs in a trend, then it broke down. So this time also we had the risk to see a breakdown, but given the trade hopes and some of the value stocks rebounds, the stock market didn't break down. It broke up. It broke, so it rebounded sharply, which might mean that we're going to see a retest of the highs, and eventually even move a bit higher in the short term in the S&P 500. If we don't have a negative announcement or a tweet from Donald Trump ahead of the Fed meeting, which I thought could actually be a risk, because he likes to criticize the Fed, and he likes to ask for sharper rate cuts. So to give them some pressure in terms of a market correction and maybe yields going down could be a tactic that wouldn't surprise us completely. But I mean, we have no way to find out really what's going on in the head of President Trump. So it's very tough to really see the direction of the market in the short term. Most likely, we're just going to see more volatility. So what is our current strategy? The strategy hasn't changed at all. Given the risk of having a policy mistake or an escalation, a renewed escalation in terms of trade war, or eventually also to have a negative dynamic that cannot be stopped because of the already implemented tariffs and the manufacturing recession that we have in many countries, the risk of a recession is real. It's not more than 50%. So probably we agree that the likelihood is probably less than 50% to see a recession in the next 12 months, but it is a risk. So what we recommend to investors is basically three things. First, don't exit the equity market completely. Always keep one foot in the market. So we still like some segments of the markets, some sectors in the US, some growth sectors in the US, like some discretionary stocks, some softwares, electronic payment stocks, medtech, and so on. So these are sectors that we still like, and we believe that investors should stay invested. but we also recommend investors to increase some of the protections in the portfolios, which we would do with the inclusion of more defensive sectors like the utility sector. And we would also do it via the higher exposure to some of the segments that would protect us in case of a recession, which is mainly gold and longer term US treasuries. So we have continued to build up these positions with the target to get to 5% in the portfolios in terms of gold in a portfolio, and up to 5% also in longer term US treasuries, which is just a way to get some protection in case that the equity markets don't perform very well. And the third point, the most important point in our view, where we really differentiate ourselves from most advisors, we really focus on the alternatives part, where we have different sources of returns that are completely uncorrelated to the financial markets, and very mostly also uncorrelated to the state of the economy. So we believe that investors should have a pretty high exposure to alternatives. If someone is more conservative, we would do it via private debt, and if someone is very aggressive, you can also do it via other alternatives. So if we look at our model portfolios or investment profiles that we have right now, I mean, this is nothing new, but if we take like the most common moderate profile that we see a lot in especially in Latin America, where a lot of clients have a very conservative profile. So right now in the moderate portfolio, we would have around 40% in fixed income, around 20% in equities, with 23% in equities, and around 35% in alternative investments. If we look at the balanced portfolios, obviously the equity part is a bit higher, the fixed income is a bit lower, but still we would always recommend investors to have a relatively high exposure to alternatives, where an area where we have built up a lot of expertise in our company, especially in a world of negative yields in fixed income and a lot of risks in the equity markets right now. 40% recession risk might happen, might not happen, but it's very important to diversify right now. So I hope that with this I gave you some insights about our views on the market and how we will position ourselves. Of course, in such a short webinar, we cannot touch on everything. So if you have questions, you can type in the questions now, so I can answer the questions right now, or otherwise you can contact me anytime directly, and we can have a direct conversation. Okay, I actually got one question that is asking what's our view on gold. Gold, I mentioned it briefly that we like gold. We thought that gold was a bit overbought towards the end of last month, when the markets were when the market was really seeking safe haven investments. So right now gold has corrected. It's actually right now I think it's below 1,500 again. So we believe it's a good opportunity to continue to accumulate positions in gold. What we basically believe is that US yields are probably continue to trend down, given the willingness, given the lack of inflation, first of all. Second, yields are probably gonna go down because we have a very weak global economy, especially in Europe, where yields are very negative. So US yields are still relatively high compared to yields in other developed economies. So lower yields, and especially lower real yields, are extremely positive for gold. And also we believe that given that central banks globally are getting more aggressive in terms of their monetary policies, it's always a good strategy to hold gold, because first of all, some investors are losing confidence in central banks because of we see that the unorthodox policies and the inflation of balance sheets are really questioned by some investors, because the impact on the economy hasn't been extremely positive. And also, as central banks are accumulating reserves, especially in emerging markets, we see a lot of purchases in gold as reserves, so which is also supporting gold. So what we believe that is gold could well reach new all-time highs in the next 2 years, which could mean that gold can increase from 1,500 towards 2,000. It's going to be a volatile ride. It's a volatile asset class, of course, but it's not a bad idea to have gold in a portfolio. And if it's not for, let's say, as a play on appreciation, at least it's a play that gives you some protection for the portfolios. So we don't have further question at this point. So thank you so much for your attention and for joining this month's webinar. We're gonna hold the next webinar at the beginning of October, just to give you an update on all developments that we have. It's certainly gonna be interesting because by then we're gonna know much more about the monetary policies, the ECB meeting, the Fed meeting. We might have some economic news as well in the next couple of weeks. So I would be very happy to welcome you again in a month's time. And thanks again for your attention.